So we are both in different areas. I do live in the Dallas area, but Bruce is actually out, I believe, in Colorado right now. So I want to talk about the projects we're going to talk about today. They are actually in the Dallas and Tarrant County area. And we're going to talk about the effects of map changes on the flood insurance program. So there are some recent changes going on with the National Flood Insurance Program as well. And we'll also talk about private flood insurance. And then Bruce will also wrap it up with risk communications and resources and tools that you can use in your business. Next screen. So let's get started first talking about the Dallas and Tarrant counties. So with RiskMap, we actually deliver quality data in this area to help public and homeowners to make informed decisions about what's most important in their lives, which is their property and their families. And so we want to make sure that we deliver that in a way that helps you best. So we have non-regulatory products and we have regulatory products, but today we're going to talk about the regulatory product that you probably know about the best, which is the flood insurance rate map. So we have 5 states in Region 6, and you see them there. The one we want to talk about today is Texas, of course. And in RiskMap, we have, the last time I counted, there's about 204 projects going on in our region, but 112 of those were actually taking place in Texas. So it always has the majority of our RiskMap projects. And in Tarrant County, we actually have, I think it's, I counted last, Tarrant County, there's 25 communities. I've highlighted in blue here, the ones on this particular mapping project that are being impacted by the study. The ones that are in gray are on the panels, the map panels that are on the study, but they're not being actually impacted by the study itself. So just the blue panels, just the blue highlight ones are the ones that are actually covered by the study itself. On the next screen, this is the Dallas County communities that are actually being impacted by the flood study. The ones that are grayed are the ones that are on the panels themselves, but they are not actually being affected by the mapping study. So the 2 maps you see here are like an index map. So they show you where we have on the green side, that's the Tarrant County, and the purple side would be the Dallas County. So you see that of the, I think it's 288 panels that we've given, you see that the ones in green are the ones that are actually going to be showing up as being affected by the map changes in that area in Tarrant County. And then in Dallas, the purple ones are the communities that are being impacted on the Dallas side. So we've been coordinating this whole time with the local communities in those areas. A CTP is actually a coordinating technical partner, and cooperating technical partner. And then we also work with those people who have submitted letters of map revision. And we've already held a CCO meeting, which is a consultation coordinated meeting with a local community meeting back in January the 12th and 13th of this past year. So we've already held that meeting. So you're going to see a graphic in a minute here that'll show a little bit later on the timeline. But that meeting was held. We're still getting some letters out right now. So on where the arrow is, it's actually should be past the blue bar that says the consultation coordination officer meeting. But the next step on the timeline would be we're coming up on the 90-day appeal and comment period. So we've got to get some more documentation done, but once that happens, you'll see the 90-day appeal and comment period will start. And that's where the community is able to submit their appeals and comments to FEMA. They usually go through their community official to communicate the changes they'd like to see. They see that there's maybe a street is spelled wrong, or maybe something is misspelled or mislabeled on the map. A change to the base map, in other words. Now, if they see that there's a technical error, something is miscalculated, they would have to see something that's actually incorrectly mapped. Maybe they see that something is incorrect or technically wrong, then they have to actually show that it's been calculated wrong. They have to do an analysis, and that would be called an appeal. So that could be done during that time also, but they'd have to show us what the correction should be. And they can submit that during the 90-day appeal and comment period off also. They can't just say, I don't like the map. They need to say, what needs to be changed on the map. So they'd have to do additional analysis. The second time that you could submit a change to the map would be after the map goes effective. That's that second brown triangle you see there. And that's when you submit a letter of map change, and it says LOMAC at the bottom. So after the map goes effective, you can also submit information to FEMA that says, it's a letter of map change. You can get the map updated then through a letter. So it doesn't change the map, but a letter says that you should, that property would be mapped out. So there's 2 times that you can actually change that, the property showing on the map. So on the map part of it, if you have some questions, we can take those at this time. I'm going to open up the chat, see if I see any questions coming up. I don't see any questions, but I'll be monitoring the chat box. I'm going to turn it over to Bruce next. If I see any mapping questions come up, I'll be taking those. And then if I see any questions for Bruce, when we come to times, I'll be asking Bruce those questions if anything pops up during that at a time. So I'll turn it back over to Bruce now. Thank you.
Can you guys hear me okay?
Yes, we can hear you.
Okay. Let me turn this up here. Sorry, have malfunction with my headphone. Apologize. So just to clarify or expand upon what Diane happened to mention is that the changes are going on all the time in maps, and we're focusing this one on what's happening in Dallas Tarrant, but there are other counties around the area that will be also experiencing map changes. So you need to stay up to date. So what hopefully you learned today will apply as those other areas go through map changes. But before we start, what I'd like to do is ask a poll question. We'd like to get a little interactive, find out what you people think about different aspects that we presented. The first one is, if you can put up, Elizabeth, do you live in a flood zone? Very simple. It could be yes, no, or not sure. So let us know. Do you live in a flood zone? And Elizabeth, I'll let you figure out when you think we've got enough responses to go ahead and post the findings.
We are about 85%. So I'm going to go ahead and end it now and then share those results.
Okay, great. So the majority of you say that you're not in a flood zone, and some are unsure, and that's always what we hear. Sometimes we actually hear a little more. A few of you are in a quote flood zone, and it's kind of a trick question because everybody lives in a flood zone. It's the level of risk that's different. So there in Dallas and Tarrant County, FEMA and the counties and communities do not map the no flood risk or the no flood zone. You're either at a moderate or low risk, which is known as zone X, and we'll cover that, or you're at a high risk zone A. Or if you happen to deal with any properties along the coast, they may be right along the water there or close thereof. They're known as a V zone. So kind of a trick question, but I'm going to come back to that later, because when your client asks you, well, are we in a flood zone? We really want you to say, yeah, but let's find out what level of risk. And don't say, oh, no, you are, or no, you are not. Especially as we've seen from Mother Nature storms recently, she's not following the maps on the line. Not that the maps are bad, it's just that the storms are much bigger than what Congress told FEMA to map to. So with all of that, let's go in, start going forward here, and let's look at some of the basics. First is a waiting period. Most of you probably know this if you dealt a little bit with flood. Unique to the product is a thing called a 30-day waiting period. However, there are 3 exceptions. One is a loan transaction. So if the lender requires it, then there is no waiting, 0 days. I'll go to the bottom one, a post-wildfire conditions. There's no wait. That's pretty technical. Don't have that issue in the area, so I'm not going to spend time talking about it. But the middle one is something that's new. Not new, it's been around for a long time, but new to perhaps many of you because you haven't had a map change in a long time. And that is a 1-day waiting period. So stick with me on this, because you're going to hear about different time periods and what have you through this presentation. When a map becomes effective, and your property is newly identified to be at high risk, so you're now in a zone A and you weren't before, and the lender's now requiring it. Let's say though you don't have a loan, so if the lender was requiring it to be 0 days, let's say you don't have a loan, So what do you do? Well, what they came up with, it said there was a 1-day waiting period. So if you're newly identified to be at high risk, if you don't have a lender, you only have to wait 1 day. So how long do you have to go get that policy? Actually, FEMA says you've got 13 months. I don't know what came up 13 months. I've been in this program a long time, and I talked to people who've been in the program even longer than I did before they retired, and they weren't quite sure how they came up with that number. But 13 months after MAP becomes effective, you don't have a loan, you're newly identified to be in high risk, you have a 1-day waiting period. But as you'll see through the discussion, if you find out right now with these preliminary maps, they're up on the map viewers, that your client's at high risk or you're going in an area high risk, don't wait. Mother Nature's not going to wait. So another one unique about the NFIP policy, it's a 1-day waiting period. That's kind of unusual. It's a 1 year, 1-day waiting period. Sorry. It's kind of unusual because usually maybe auto might by 6 months. NFIP is 1 year and you have to pay that up front. That's the unusual thing. Usually you might get a payment program or whatever. FEMA wanted to get away from doing a payment program. Why? Because they were afraid that people would pay during the hurricane season, let's say, or during the rainy season, whatever it might be, or if you're out in California, the wildfire season comes and then the rainy season comes in like December, they'd cover it December to May, or in the coast and maybe your area, you might cover it from May to October, November. So they said, no, let's get it all up front and by check, money order, credit card. You don't see cash, do you? Why? Because they need evidence to start that 30-day, 1 day, whatever clock ticking. So that's the date on the check or money order credit card. You don't have that with check. And here's something very unique, and it's important for you as realtors to know this. The policy can be assigned to the new owner. What does that mean? That means, as you'll hear some really neat rating options that FEMA has when MAP changes so you don't get hit with high premiums due to the new MAP. If the property owner has a policy in effect before the maps change, they can assign that policy over to the new owner so they can get the benefit of whatever type of rating options going on. That's an awesome, awesome selling point. So even if these map changes are occurring, if you know in 6 months, a year's time that this property is going to be in a high risk area, buy a low risk policy, as you'll see. And there's a unique rating we'll talk about in a minute that applies that you can then use that transfer over to the new owner. What a great selling point. So keep that in mind. Okay. So what about building types? Well, we've got different types of buildings. You've got residential, which are primary, or Congress called it in their act non-primary, but essentially secondary homes, and 1 to 4 families. And you'll hear the term instead of primary, sometimes principal. I'll cover over that because it is a little confusing. But if you look at the book of business that the NFIP has, 95% of it is residential. Very little is non-residential or commercial, which is the next one, non-residential business. Then you have what are known as non-residential, all those others that aren't businesses like churches or something. And then we have the condominium associations. And FEMA created a policy for those, residential condominium association building policy, which we in the FEMA world love acronyms, and we call it the RCBAP. We're not going to get into the RCBAP, that's a whole thing on its own, but wanted to let you know that rating is based upon, one of the things is based upon building type. So I mentioned primary versus principal. So primary basically is for rating. So when your client goes to an insurance agent to be rated, they're going to be asked, is this your primary residence or is it a non-primary secondary residence? Primary means they've lived in that building for more than 50% of the previous year. And interestingly enough, FEMA has come to the point, and I'll mention this again, that you can have 2 primary residences, and I'll explain that in a minute. So that's primary. And that term is important. As you see, it affects how things are rated. But then you'll hear a thing called principal resident, and you notice the definition is different. It's where the insured or insured spouse have lived in at least 80%, not 50, 80% of the 365 days before a loss. So principal is used for loss settlement. And basically, you have to have a principal resident to get replacement cost in a building. And that's the basic way besides the RCBAP. So this principle is used for loss settlement and allowing people to get replacement cost. Otherwise, everything is called actual cash value or the depreciated cost. So let's get into some of the detail about rating. Here are some essential elements of rating. What community you're in, when was the building constructed, are you getting a community rating system discount, occupancy type, number of floors, building coverage, etc. But the main ones we want to talk about are pre-firm or post-firm, and I'll help you define those because that's, again, important when you're buying or selling a home. Is it pre or post-firm? Because that could affect how it's rated, and then how much the new owner may pay versus the previous owner. What flood zone is it in? Again, we're all at risk. We're all in a flood zone. Is it a moderate or low risk X or a high risk zone AV? And what's the difference between the base flood? Now, the base flood is the water level that's an 100-year flood, that 1% annual flood is to here. How much higher is your lowest floor? The higher it is, the better the premium. But I wanted to just also show you, this is what an application looks like. It's a little dated, but still about the same. Like size 6 font, 11 by 14 inch page paper. Now, luckily, this is all computerized, but we do have it. It gives you an idea. There's up to over 100 questions that could be asked to rate flood insurance. So let me also talk about some of the different rates that we have. We have the preferred risk rate, which is zone B, C, or X. It's got limited loss history. These zones, which we don't have too many across the U.S., and AR, A99 eligible. And what it is, if you're in a low risk area and you really don't have any losses, you can get inexpensive, comparatively speaking, flood insurance starting at less than $300 a year. And from an agent perspective, they are fixed premiums and limits. So it's not all over the board. It's different choices of fixed premium premium for building coverage, and then 40% of that automatically contents. It's the only policy that they have, FEMA does, that automatically includes 40% of contents, just kind of like your homeowners does now. So to kind of give you an idea of what those are like, think about auto insurance. Most of us today on this webinar probably have auto insurance. Think about way back, for those who have gotten married and both you and your spouse beforehand had good driving records, no tickets or accidents or anything. You get married and you get really special rates, preferred rates, because you've got a clean record. And then as the game of life goes, which is a fun game to play, even as an adult these days, it seems, you get kids, and the kids slowly grow up and they suddenly turn 16. And what happens to your auto rates? They shoot up. Why? Because they know at that age they're going to have accidents or tickets. They know that their sons are going to come home and say, Dad, really, I wasn't going as fast as that radar gun was saying it was. It had to be broken. And yes, I've had that conversation with my son. But why? They're a higher risk. And so instead of, you don't get those preferred rates anymore, you get more standard rates. And that's the same with flood insurance. So if you haven't had
Give us just a second, everybody. I'm going to try and get Bruce back on.
Sorry about that. I lost the internet here. Let me reshare. Wrong screen. Hold on a second. All right, sorry. Elizabeth or Diane, you hear me okay? Or anybody else in the class, right? Thumbs?
Yep,
Yep.
we're good.
Thank you.
Yes.
Sorry about that. So you get the special rates. Let me go back some. These special rates over here. And basically you start at that low cost preferred risk policy rate and slowly then move up to a full risk rate. And I'll give a little more details on it, but they didn't want to penalize you that you are now at a higher risk and you didn't do anything. The next thing I want to talk about is pre-firm versus post-firm. Firm is flood insurance rate map, as you see at the top of the page. And basically, pre-firm, pre means before, is anything built before the first flood map. But back then, they didn't have these ordinances to say, don't build where you're supposed to. The community didn't know better. They didn't have the maps to tell them that that was a high-risk area. So Congress said when they created this program was to basically, let's give them cheaper rates. Let's give them subsidized rates. Now, it's not subsidized by you and me, the taxpayer, but by actually other policyholders. So I have a preferred risk policy. I'm paying probably a couple dollars more than I probably would be charged. So these people who have homes that were built before the first flood map in their community aren't, quote, penalized or have to pay the full risk. Well, back in 2012 and again in 2014, Congress passed legislation that said, no more. We need to make this program financially solid. So we are going to be moving some of those rates up pretty quickly to what are known as their full risk rates, actuarial rates. And I'll talk about that in a little more. But those buildings right now are known as pre-firm. It does affect the rating. It does affect transferring the policies. It does affect if you leave the program for a private flood. So please understand when you are selling a home, find out the flood zone. And then if it's in a high risk flood zone, or even low risk, when was it built or last substantially improved, which means more than 50% of its value. So if it was built on or after the first flood map, it's known as post-firm. And those are built based upon, I should say, the floodplain ordinances that are in place. And when a community joins the Nfip, they raise their hand, they say, we promise to enforce the minimum standards, and a lot of them have higher standards, to build so they are less in harm's way. And so they build to that 1% annual chance flood, or as they say, higher. And in most cases right now, an elevation certificate is required to rate those. And many of you are probably familiar that they'll have to go hire a surveyor if there's not one already done. And that will then be provided to the agent to then rate. But that's called the full risk rate. So I've got a question for you, Elizabeth, our next polling question. If Dallas County, and it was, so Dallas County first firm, it was July 19th, 1982. So if a house was built on July 19th, 1981, is it pre-firm or post-firm? So again, Dallas County's first flood map was July 19th, 1982, and a house was built July 19th, 1981. Is it pre or post? Think about back to your high school English and what those two terms mean and how they relate then to the dates. Okay, we're probably getting pretty stable, it looks like. And the majority of you, almost 90% of you, said pre-firm. And that's correct, because 1981 is before 1982. So it is a pre-firm building. It will be receiving perhaps some subsidized premiums if it hasn't already been rated full risk. But there'll be some implications as I mentioned, going forward about those pre-firm versus post-firm. So let's go on and talk about flood zones next. So two major types. One's called the non-special flood hazard areas. You don't hear that term as much anymore, but you might, so I put it out there. I personally don't like it because the word NO is in non, and that's kind of how many of you responded, saying, I'm not in a flood zone. This is not a flood hazard area. When in fact, we know in these moderate to low risk areas, flooding does occur. In fact, if you look at the third major bullet down, more than 40% of the claims in Texas, flood claims, have come from policyholders in these moderate to low risk areas. In fact, that number is much higher, because when I did the calculation, it was pre-Harvey. So think how many storms have happened since then down in Houston area. So you have the moderate risk area, which on old maps is zone B. On the new maps is a shaded zone X. So in this one, it would be this black stippled area right here would be the moderate risk. Where there's no shading, that's the low risk zone. In the old maps, it's zone C, and in the new maps, it's zone, oh, you might have seen zone X as well. And in the new maps, they're all zone X. It's in this area and the black stippled area, dotted area, that you can get that lower cost preferred risk policy starting at less than $300 a year. We also have the, let me go back one, special flood hazard areas known as high risk areas. These are zone V on the coast, V for velocity, and zone A could be AE, AO, just A by itself, AH. That's where we have that 1% annual chance. It translates to quote 100-year, but that's a misnomer, because people think, oh, well, we got flooded last year. I got 99 more years before it happens. No, that's 1% chance any given year. If you do the math on that, that means you've got just over a 1 out of 4 chance in a 30-year mortgage. So that's a pretty high chance if you think about it. And it's in these areas that if you're a federally regulated or insured lender, they're going to, and you have a loan through them, sorry, you're going to be required to carry flood insurance. That's the federal mandatory purchase requirement. We'll talk about that in a minute. And in these areas, they also give what are known as the base flood elevation, which is here circled in the red. And that's what the agent uses to help rate. That's where the lowest floor has to be above that number. That's above sea level, by the way. That one shows to be, 616 feet? No, it doesn't have to be 616 feet in the air. I say that because I've gotten that question. And it's also used by floodplain managers as to the minimum height that a building needs to be constructed. As I mentioned, some communities have even higher requirements known as freeboard, where they say you got to build a foot above that number, or 2 feet, whatever it might be. Finally, one that we don't see too much of, but I want to mention, is a zone D. And a zone D is where there's no analysis that's been conducted. Typically, we're now seeing it pop up behind some new levy analyses. The downside, it's called possible but undetermined. And so people look at this and say, well, if you don't know, then I'm not going to get flood insurance until you tell me. And there's no building requirement, so they can build with basements or whatever else, and actually might be building at risk. So don't like to use the zone D that much, but I wanted to let you know that's out there. There's no lender requirement with it either. So really those people may be kind of the most exposed out there. So next, I mentioned the mandatory purchase requirement. So let's talk about that a little more. If you are federally regulated or insured, your loan, you're going to be required to carry flood insurance. People mix up saying FEMA is requiring me to get flood insurance. FEMA is not. That law was passed by Congress to tell the lenders, we want you to protect your loan portfolio. And if they're in high risk areas, they better make sure they've got flood insurance. What triggers that? If you're making, increasing, renewing, or extending a loan. I like the acronym MIRE. Again, we all like acronyms in the world of FEMA here, and the federal government. So MIRE, it might be one to help you remember that if a person has a loan and they're making a loan, or they're increasing it, renewing it, or extending it, then that will trigger that requirement. The law came out saying it has to be in effect for the life of that loan. So as long as it's in a special flood hazard area, and as long as there's a loan on it, you're going to be required to carry it. It used to be that if you escrowed anything, homeowners insurance, taxes, you would have to also escrow flood insurance. They changed the rule, and now every loan, if flood insurance is being required, they're going to have to escrow it. Why? Because they want to make sure it stays in place. Too often people drop it, forget, they think, oh, the bank's taking care of it. And then when the flood hits, they suddenly realize we're not covered. Another rule that also changed recently was saying that if the house is up here, and hopefully you can see my hand, and just down the hill is your garage, and the garage is in zone A and the house is zone X, and that line's right between my fingers, between the two flood zones. It used to be that if this was in a high-risk area, all of the buildings, the garage, the detached garage and the house would be required to carry flood insurance. The new rule says if the detached garage, which is only used as a garage, is no longer is in the floodplain, and this is not, there is no federal requirement. The good news is then you can get a preferred risk policy and cheaply insure both. So it is a somewhat new exception, and then it occurs occasionally, but we don't see a lot of that out there. So next I want to talk about then what's required. And this gets a little confusing, but it's the outstanding loan balance, the maximum available, which is $250 for the home right now, or the insurable value of the building. Most of the time, it's that first one, how much is left? And this is when we run into a problem, because if you remember back to my discussion of that principal residence, you had to be insured to at least a principal residence to get replacement costs, has to be insured to 80% of the value as well as lived in 80% of the time. Well, if the home is worth 200, but you put a lot of money in it and you only have 120 or 100 left, then it's not at 80% of value, the coverage. You're only getting that 100,000 because that's all the lender is going to require. And therefore, when it comes to claim time, you don't get replacement cost. You get actual cash value. In some of our big storms, we hear stories, whether it was Katrina, Harvey, Irma, Melda, Sandy, of people who just paid, got insurance for the amount of the balance. And then when it did flood, they weren't fully insured. So that's something, if you get in that conversation, again, you're not insurance agents, but wanted to let you know, you can pass a little wisdom on to say, yeah, you can, but you better check with your agent, because you might not, insurance agent, you might not get replacement cost value. If the lender does not have a policy in place, the lender is going to send a letter and say, hey, we noticed that you're in a high risk area, maybe it's due to a map change. Could you send us evidence of coverage? And in 30 days go by, they haven't heard from you, because probably like you and me, yeah, I'll get to it, I'll throw it away, or it's just from the bank and it's nothing. They come back, hey, we haven't gotten anything from you. And if we don't hear anything, we're going to force place it in 15 days. So when that 45-day period is up, they will force place it. And I will tell you, force place coverage is very expensive, anywhere from 3 to 10 times more expensive on average from numbers I've looked at. And usually that is a wake-up call, and people quickly go out and get a policy. Most of the force placed is now done through the private market. There are only like a few hundred left in the Nfip's force placed program, known as the Mfip. So most of it, as I say, is through the private. But hopefully we won't run into that situation there. So let's talk about base flood elevations. That's another rating option. Remember, I said the water is going to come up to a certain level. That is the height In this case, I just arbitrarily from this photo said maybe that was about the BFE because it looks like things are elevated up except for that lower floor, to where they think that 100-year flood is going to come to, that 1% annual chance flood. And then if it's built any higher than that, they will provide perhaps a discount. So on the coast, what we're finding that it's the bottom of that member, that V zone, because if you look at that lower picture, the waves are going to hit the bottom of that lowest horizontal structure. Where in the top picture, if you look at it, those are on slab. And so it's really, they measure it to the top of the slab as far as what is the elevation of that lowest floor. And then when it's the difference of the two, that's how they help determine rate. And the higher that difference, the lower the rate. So let's talk about the effects of map changes now on insurance. There's basically 4 that I want to cover today. And we'll be stopping for some questions here soon. Newly identified to be at high risk. That's going from zone X to zone AE. High risk properties identified to be at a higher risk. So they were in zone AE, and let's say on the coast, and now you're in zone VE. Or that base flood elevation I just talked about was here, and now the new map say, actually, we think that floodwaters are going to be higher than what was shown 10, 12, 15, 20 years ago on the old maps. New data has shown that. But we also see, because of new data, better modeling, better technology, where the floodplain is shrinking. And actually, that means they're now identified to be at a moderate low risk, no longer at a high risk. But again, the risk is only reduced. It has not been removed, because if you remember, we talked about there's no such thing as a no risk zone that FEMA maps. But in most cases, almost all cases, there's going to be areas which are not changed at all. But people are going to be asking questions. So it's good to be educated about these map changes. And we'll tell you some resources to go to help identify what that flood risk is. So the 3 main rating options we're going to talk about today is newly identified to be at high risk, preferred risk policies if purchased within the first 12 months that the map is, they can then qualify for this newly mapped procedure. So you got 12 months, you got a window of 12 months to get a PRP in place. You have to qualify for it. And then it will slowly go up in premium. And I'll give you an example of that. If you're in an area, let's say you don't qualify for the PRP because you've had too many claims, or you've gone from zone A to V, or that BFE is increased, 2 ways known as grandfathering that can be done. One is called continuous coverage. It's for, it doesn't matter when the building was built, before or after the first flood map, but it says have a policy in place before the maps change, and then maintain coverage. And as I mentioned, you can transfer or assign that policy over to a new owner, and they can continue on with that lower rating option. If, let's say, oh gosh, I didn't hear about it or whatever, am I out of luck? Now that the maps become effective, there's another one called built-in compliance. It's available only for post-firm buildings. Why? Because look at the term built-in compliance. Built-in compliance with a flood map. Well, pre-firm, there are no flood maps. So you can't show I was built in compliance with the flood map in effect at the time the house was constructed. So what we recommend is go look at the preliminary flood maps that came out that Diane talked about. Find out what's changed. And if you're in one of these situations where like the base flood elevation has increased, get a policy or make sure you have a policy in place when the maps become effective. Then it's an easy thing for the agent, for you, and then in the future owner as well. But as mentioned, there are going to be cases and times when the risk has been reduced, where you've been at a high risk and now you're at a moderate or low risk. And it's an easy process to take the policy you had here at the high risk and convert it to a preferred risk policy and maintain coverage. No gaps, no extra money up in front, etc. So let's jump into each one of these. Here we have Zone X, nice little red house, enjoying itself in a moderate low risk area. And along comes a new map change, and it's now in a zone AE. And the first thing that happens is those letters start going out. On average, about 60 days after a map change that takes effect, though we're seeing it a little earlier, but we also hear cases when over a year goes by before they get notification. But that kicks in no matter what, the effective date of that new map. And so people think, oh my gosh, the risk is increasing, so it's going to get really costly. What am I, what's a mother to do type thing? So FEMA provided this cost-saving option, as I mentioned earlier, called the newly mapped procedure, which again, you start at the low-cost preferred risk rates, and you have to have a policy in place over 12 months, and then you'll slowly go up in premium. Now, as I just mentioned, there are some lenders who are a little slow in picking up where all the map changes are going on in the U.S. So we were seeing cases where the property owner was being notified more than 12 months in advance. So FEMA came up with a rule that said, okay, if you get notified by a lender between 12 and 24 months after the map changes, we'll let you use this newly mapped procedure. But you know what, folks? I would not count on that. Get the flood insurance in place. In fact, we recommend get it in place now before the maps change, because it could actually be some cost savings there for you. And let me show you how that would work. So let's say the maps became effective this August. They're not, but just pick the date. That means that 12-month window that you have to purchase a PRP to get on that slow staircase up would be July 31st. But if you have a policy in effect, I think the 30-day waiting period, so actually you'd have to buy it in June, but we really say get it way before. But let's say it's in effect here. It renews during that 12-month window, so it still continues as a preferred risk policy and won't go up, which right now an annual 15% a year. So now you get almost 2 years of a preferred risk policy before then it starts going up in premium. So the question I get quite often is, okay, Bruce, when does it stop? Does FEMA come in and say, okay, you're there, you're at high risk? No, the insurance agent has to. And what he or she does is compare it to what the standard zone X rate is at the time. So in this example right now, the standard zone X rate's around $1,600. That's going to be going up as well, just because like your health and auto and homeowners insurance rates always go up. But once it gets there, you don't have to be on that 15% annual increase or whatever the number is that each year, because FEMA can change it. You can get off that staircase. Let me give you an example. So here again, we have the zone X. It's now in zone AE, and newly mapped procedure says, hey, go get that PRP. So we do. And we get it this time for the full limits, 250 in building, and 1,000 and 100,000 in contents. And each year it's going to renew up the staircase. In this case right now, we've been averaging 15% increase a year. But the savvy insurance agent says, or real estate agent says, hey, you've got some vents under there, and that counts as perhaps being elevated then, because then the top of the floor is now there, not down by the green grass. And usually when I do this course, it's like in the afternoon or morning, whatever, I ask a simple question of what's the difference in elevation? Well, it's a +2. So a +2 calculates out, excuse me, to $915. In this example, you don't have to go to that $1,600 or whatever it is. You get off that staircase of increased premiums when it reaches that difference. So the agent has to be a little savvy, but the reason I go through this illustration is to let you know that, yeah, the target premium may be really high, but there are buildings out there today that are elevated that could end up getting off that staircase much, much earlier, much cheaper. But again, the bottom line is there is this rating option called the newly mapped procedure that does reduce the financial impact. So what are some things you say when this happens? And I'm not going to spend a lot of time on this. You're going to get, if you haven't already, a copy of this PowerPoint. But basically, you're in a high-risk area. Lenders are going to require flood insurance in these areas. But you know what? the National Flood Insurance Program has these cost-saving options like this newly mapped procedure to help reduce that financial impact I said, because in areas like this, newly identified, if you're now in a high-risk area, you're more likely to have a flood than a fire. So even if you don't have a loan, get some flood insurance. And again, the saving thing is if you have just a little bit, some of it in place, you can then transfer that policy over to the new owner, and then he and she can increase it or do whatever they want with it. But at least it could be a good selling point, and it will protect you when, not if, that flood hits. So let's move on to the next example. And that's going from a high risk to even a higher risk zone. So you're in zone AE to zone VE. And I mentioned this to you because some of you may have people who have, some of your clients have property down in, on the coast in Galveston, Corpus Christi, wherever it may be. And in this case, where we suddenly find it in a zone VE, as I mentioned, the federal mandatory purchase requirement is there, and people are thinking, oh, now, my goodness, I'm in a V zone. I'm going to have to pay a lot more money. But in reality, as I mentioned, we have this thing called grandfathering. And grandfathering helps you reduce, again, that impact, because you use that zone E for future rating in perpetuity, which means you're not keeping the rates, but you're using zone AE for rating, and zone AE rates are cheaper than zone VE rates. So therefore, you lock in that lower risk zone for future ratings. But if you remember, I talked about pre-firm buildings. Pre-firm buildings have to have a policy in place before the maps change, become effective. So please keep that in mind. Again, remember I told you the importance of pre-firm, post-firm. Know the age of the building, know the age of construction, when was it constructed versus when the first flood map was issued for that community. So another one that we'll see more of, because we're not talking coast when we're Dallas and Tarrant. If we're talking coast, we've got definitely a global warming issue here, or climate change issue. So let's say you're in zone AE, and now the new maps come out and say, oh, the base flood elevation, the height of floodwaters, that 1% annual chance occurring, are actually, we found to be higher. And so the same sort of scenario applies with grandfathering. You can actually, though, use the lower base flood elevation, which has lower rates, than using the new base flood elevation. And so therefore, again, a great cost savings, and it can be passed on to the new owner. And again, pre-firm buildings, policy enforced before the maps change. What are some of the things you say? Somewhat similar. You're now at a higher risk, and which means rates are typically higher, but you can actually purchase a policy and lock in, and that's a good term we found that people can visualize, a lock or something like that, in the lower risk zone, or lock in that lower base flood elevation for future rating. So it's a great savings on flood insurance. Make sure, though, you renew the policy each year, one, to stay financially protected, and two, I'll talk about certain cases that if you let it lapse, which means you didn't renew, you could lose out on the rating option going forward. And again, in a high risk area, you got that 1 in 4 chance of the life of 30-year flood. Why chance it? And if you don't have a mortgage, get a policy anyway, because then that's giving you some protection, and it can be transferred, that rating option, onto the new owner. Okay, as I mentioned, though, there are situations and times when you have a house here in zone AE, high risk area, and the new maps, because of better detail, better modeling, better rain data, etc., is now in a zone X. So the risk has been reduced but not removed. What has been removed is the federal mandatory purchase requirement. Now, lenders can always say, well, we still think it's at risk, so we want you to carry flood insurance, though it doesn't have to be a zone AE policy. But the risk is still there. And as I mentioned, 40% of the claims in Texas, and probably even higher than that, come from policyholders in the moderate to low risk area. So it's only reduced, not removed. So there's a way to convert that high risk policy that you have in zone AE to a preferred risk policy. It's pretty simple. And the beauty is you keep your home and your contents in protected financially, because as mentioned, you're still at risk. And what we do is we ask the insurance agents to document if they don't want it, that they decline it and sign it, okay? And if the insurer does insist on canceling, they'll get a prorated refund for the time that it was in a high-risk area, that policy year. But gosh, we sure hope they'll follow this procedure. The agent pushes and promotes it. It's called conversion. Not the religious type, but for flood nerds like me, we're kind of into this. And basically what the agent will do is make sure it qualifies. So you're at a high-risk policy, make sure it qualifies for the PRP. In other words, it hasn't had too many claims. Then you pick a limit that's close. Remember, I told you the PRP limits are fixed. So pick a fixed limit that's close to what it has now, and then just rewrite it. So let's say that high-risk policy was $1,600. The PRP is around $500. Now, again, I usually ask the class, what's the difference? And, depending if the coffee's kicked in or not, that comes out to $1,100. So by converting it over, they use that $1,600 to pay for the $600 or $500 premium. That leaves $1,100 that they're going to get back as a refund. And by doing so, there's no waiting period, no gap in coverage. And the insurance agent gets to keep commission on both policies. Why? Because they spent a lot of time to write that high-risk policy, and they would lose that commission. So they get to keep that and it. So it's an incentive. They created this back in the mid-2000s, around like 2006, I think, when the Sacramento and American River levees in California were accredited, and suddenly 80,000 policies were no longer going to be required to, or properties be required to carry flood insurance. And they were worried that everybody would drop it. So they created this method. They did a lot of promotion around it saying, hey, stay protected. You're still at risk. A levee can go at any time. And there in Dallas and Tarrant counties, you've got levees all over. And you guys know that the exposure there. And by creating this, 77% of the people retain their policy the first year. So it does work. It's an easy process, and it helps financially, again, protect that person that is being affected by this map change. So what do you say to people like that? Again, the agent will be saying this more than you, but this is the key number one. The risk is reduced. It is not removed. You are still at risk, even if you're now in a zone X. And that in these low risk areas, more than 40% of the people are filing claims. And those are the people who have a flood policy. You heard all the stories of the people who did not have a flood policy and had to rely on individual assistance, which is not much. If it comes as a grant, average, I think, in Harvey was 5,000, I think. And if they get an SBA loan, they have to pay that back along with the existing mortgage on top of that. So it's actually even more onerous. And if they're at high risk area, they got to get a flood insurance policy. So why not just get it now? You may be eligible for a lower cost PRP. In this case, hopefully you will. Convert the policy, get money back, no gap in coverage. It's a win-win for everybody, including the community, because then people have a policy, and they've shown in research that those communities, the more policies in place, recover more quickly, are more resilient. So we want to encourage that all of us. Now, here is something really that you have a lot of, and that is where there's no change in the flood risk, but they're still at risk. So it's important for them to know what the level of the risk is. If you have flood insurance, is it a replacement cost? Remember I told you about the loan? And a lot of people only get for what the lender requires. And if so, if it's not 80% of the value of the home, and over time it definitely will not be, then they'll only get actual cash value, not replacement cost. And the lender only requires it typically on the building. So the contents, do you have contents coverage? So good things to think about. And if they don't have coverage, maybe they'll qualify for the PRP, because there's a good chance they're probably then in zone X. And if they don't want it, we ask the insurance agents to decline it in writing, and they have forms, just like the real estate world has forms. They have forms here known as rejection forms. Most companies kind of have their own, or an agency will create their own, or there's a service out there called Accord like this that has one as well. So in the past hour or so, we've covered a lot. Summarize, if the risk is increasing, there are money-saving options. One of the big ones is grandfather. You lock in that lower risk zone, or you lock in the case of Dallas, Tarrant area, that lower base flood elevation. Or if you're going from a low risk to a high risk, you're newly identified to be in high risk, there's that newly mapped procedure, starting out at that preferred risk policy. But we have cases where the risk is decreasing, and we encourage then for those policyholders to convert their policy over to a PRP. Really easy, no money up front, and get a refund. But the majority of time, there are people who are just not having any change in risk, and that's a good time to have them look into their policy and say, hey, am I fully covered? Do I have what I need? Building contents. Do I have even coverage to begin with on it? The most frequently asked questions when we have open houses, those good old days when we could do them in person, and typically we would do a stakeholder workshop like this before a major map change going on in Dallas. So we are now doing these open houses virtually as well in major areas. Three that I get and other people get, insurance agent gets, you may get as well. So how am I affected? Okay, new maps are out. How am I affected? So we want them to go look up their floods, what their flood zone is, flood risk, and I'll give you some resources for that. Then they find out, let's say they're in a high risk area. Okay, what do I do now? And they look at me across the table and say, okay, Bruce, really, you know the answer. What's the cheapest cost on this now that I find out I'm in a high risk area now? The purpose of today was to make you aware as a real estate professional what the changes are, so you can guide them to the best and least expensive option. The details of it, leave that for the insurance agent, but at least you can coach them into saying, hey, don't worry about it. There is a way to reduce that financial impact. Or you may be selling the home, and right now it's in a high risk area, but you go to this map viewer that I'm going to tell you about, you find out in 6 months, or whenever the map becomes effective, a year from now, it's going to be in a moderate low risk area. So yeah, have a policy in place, you can convert it PRP, but what a sales pitch to them saying, yeah, it's high risk, but the new maps are actually going to show it's in a low risk area. Or vice versa. You found out that, okay, it's in a low risk area, but the new map showed that my client's house is in a year's time going to be in a high risk area. What am I going to, it's going to affect how I sell it. Well, get a preferred risk policy in place and, then start that newly mapped procedure. You can transfer that policy over to the new owner of the home. So knowing what the changes are and knowing the options available can actually end up being a sales tool for you. Okay, so what are 3 things that I and others would like you not to say during these map changes? And the first one, you've heard me say over and over again. You heard Diane say it as well. And that is, you don't live in a flood zone. As you've heard me say over and over again, we all live in a flood zone. You're mapped out of or into a flood zone. No, you're always in a flood zone. What's happened is the level of risk has changed. Either it's become higher or it's become lower on that. And finally, please, as a real estate professional, do not say you don't need flood insurance. You're not a financial advisor from that perspective. Direct them to their agent to say, hey, go talk to your agent about what the best options or coverage is for you. But please don't tell them you don't need it. Let them make that decision on it. One slide I threw in here, some of you may deal with some coastal, and I wanted to let you know that if it's a secondary home, whether it's a rental or just they like to go there on weekends or spend 6 months there, whatever it might be, secondary homes do not qualify for replacement cost, only actual cash value. That could be the home down at the lake. It could be on the river, whatever it might be. Vacation homes are known as secondary or non-primary, so they don't get replacement cost. And I'll cover this next, if they're pre-firm, they built before the first flood map of that community, their rates are going up 25% a year till they reach full risk rate. And that's been happening since January 2013. Those are one of the areas that Congress said we want to make them to full risk rate as possible. Why do I mention this? Because you'll see in the next set of slides is that if a home is being used as a primary pre-firm, they may be paying this rate, but then your client comes in and buys it, and he's going to use it for a secondary, a rental home, or beach home, whatever it might be. Suddenly he finds out, or she finds out, the rates are way up here. You think, oh, there must have been a misrating. Why am I getting hit with this, etc.? Excuse me. It's because of what you see on your screen. It's a secondary home, and it was built before the first flood map. I'll get into a little more details on that. But first, I wanted to see if we had any questions. And then we're going to take a break right after this. So do we have questions?
Actually, we don't have any questions yet. A couple of them I've already answered, Bruce.
Oh, you're awesome there, Diane. Thank you very much. So let's move on to take a quick break. I have 5 past the hour. So if we can come back at 10 past the hour, that would be fabulous. And I've got a little video here that hopefully will work.
It's a very dramatic moment when water begins to enter your house. Certainly something I'll never forget. It rose over a 3-day period to be 32 inches high. It stayed like that for approximately 5 or 6 days. We were taking a boat into the house and checking the water level and measuring it.
Flooding can happen anywhere, and in Houston in 2017, it didn't just happen in high-risk areas. It happened in a lot of lower-risk areas too.
Harvey reinforced a very key statistic. Oftentimes, the homes that flood during these rain events are outside of the 100-year floodplain. So you are not safe and not immune to flooding if you're not in a 100-year or 500-year floodplain. Many of my neighbors that were outside the 500-year floodplain did not quite understand their risk of flooding.
When it came time to return home and clean up, many in Houston didn't have the resources to recover and rebuild.
This is your house, the place where all your children have been raised. You have to get it back. We're a middle-class community. Most of us are not in a position where we have available funding to recover from a major event. It's a tremendous financial burden.
In 1968, Congress created the National Flood Insurance Program, or Nfip. At the time, there weren't many affordable options for private flood insurance, especially for people living in high-risk areas. The government recognized a need for a more affordable program to help communities manage flood risk, no matter their risk level, and help reduce their risk of flooding in the future. Today, FEMA programs like the Nfip help communities and property owners better understand their flood risk and how risk can change. Using flood risk data and maps, communities can decide how to reduce their risk in ways that work best for them.
The rebuilding process really starts with your engagement with flood insurance. Thank goodness we were able to count on that for our recovery. We plan to live in this house for a very long time. We love the community, our families here. This is our home.
Learn more about how the National Flood Insurance Program can help your community understand and reduce risk. Visit FEMA.gov/mitigation.
Okay, we got about 5 minutes or so. Hopefully you've had a chance to go get some more coffee or shots of espresso to get through the rest of this in the afternoon. It's pretty heavy stuff, I understand, for an afternoon course. But hopefully you're learning basically what options are that when map changes occur. The good news is we understand the flood risk a lot better. And so we can communicate that to our clients and let them know that that home you're in is going to be at a higher risk, or it's actually going to be a lower risk. And here are things you can do about that. And communicate it, and then send them off to the insurance agent to get into the details of that. Sometimes map changes, though, are confused with changes that the NFIP is having done to it just by normal changes, or if Congress has mandated those changes. So I wanted to just spend this next section a little bit discussing some of those changes to the NFIP that may affect the program and mislead people thinking that it's these map changes. And again, the maps have to become effective for these rating options that I just told you about to take place, and the changes in flood insurance requirements. After this, I'm going to talk briefly about private flood, because we're seeing private flood out there, and FEMA does embrace private flood, because the more people that can be protected with flood insurance, that's the less disaster aid, that's the less you and I as taxpayers are paying out for that. And then finally, some really useful resources for you to go identify the flood risk, stay up to date, and understand, kind of summarize what we've just gone through. So that's where we're going to go in the next hour. Please submit your questions via the chat, and Diane will answer them the best she can. And if there are some she can, I'll be jumping on there at the end there. So what are some of the recent changes to the NFIP? Let's see if we can get this computer going. Well, I'm going to start talking about it, and if my computer decides to catch up with me, that'll be good. Here we go. So some terms that we've covered that I want to make sure we understand. One is pre-firm, and I know we covered the discussion earlier. I know we've given some examples, but please understand the importance of is it a pre or post-firm, because the pre-firm buildings built before the first flood map have been getting those subsidized rates in high-risk areas. So Zone X, they're not getting subsidized rates. And what Congress mandated to say, many of those, we want to see them up to the full risk rate, and there are different ways to getting there. And those who have secondary homes, non-primary residences, and some commercial structures, we want to get to full risk rate. And so these terms actually became very popular, if you will, used a lot after the reform of legislation in 2012 and 2014. And we've covered them. So how do they all play together now? I don't want to go through all the details of the reform legislations. So where we are today, first they put caps, how much the premium can increase a year. 15% annually was the average cap, but FEMA said, or Congress said, we will allow up to 18% for individual risk. So if you look at the current manual, they're all tables, and the tables have rates. So the average increase for that table couldn't be more than 15%. But any individual rate could go up to 18%, which means on that table, something else would have to go up no more than 12%. So on average, no more than 18%. However, as I mentioned, there are certain policies that Congress said we want 25% annual increases till they reach that full risk rate, the actuarial rate. And those are those pre-firm ones. So let's take a look at ones that you might be involved with. First, the primary residences. So Congress said, well, it's got to go up at least 5% a year if it's pre-firm. Look at the title, pre-firm, built for the first flood map in the high-risk areas or that zone D. And those rate increases will increase up to, doesn't mean they have to, but up to 15 to 18%. That's the cap that I mentioned. Non-primary or those secondary homes, your home by the lake, by the river, by the ocean, etc., a rental will increase at 25% until full risk rate. Again, the agent has to determine that full risk rate. He or she has to get the elevation certificate. They have to show when the pre-firm rate has increased enough so it becomes equivalent to an elevation rated building. That base flood elevation equals the lowest floor elevation. Then that 25% annual increase stops. And that's the example I have. Let's say this is your house, and on the backyard it overlooks this beautiful lake, and it's a secondary. Right now it's a guy who's retired and it's his home. He says, all right, I'm gonna go move in with my son and daughter, and I'm gonna sell it. So then your client says, oh, I love the view in the lake. It'd be a great secondary home to go escape from the craziness of Dallas. And so they buy it. Well, this house was built in 1968. So it's a pre-firm structure. He might have been paying $1,600 insurance. You say, oh, that's not bad. I can build that into my annual payments. But when they get the insurance quote, suddenly the new owner is looking at, I'm going to make up the number, maybe $3,000. Why? Because the use of the building went from a primary or occupancy from a primary to a secondary. So it's important not only to know is it pre-firm, post-firm as a realtor, but also how's it going to be used? Because if it's going to be used as a secondary home pre-firm, they're going to pay a lot more for insurance. Hope you followed that. If not, put it in the chat, come back and explain it. Some of you may also sell commercial buildings. And they too, if the commercial building is in a high-risk area and it's built before the first flood map, they've been seeing 25% increases a year as well. And then two other classes of buildings, if you will, known as repetitively flooded or substantially damaged as well. But the main one for your area would be the businesses, the commercial structures. So those are the two main areas as realtors you need to understand that those rates pre-firm are going up. I'll talk about a pre-firm lapse and how that affects the cost. Other things that came out from the legislation, your insurance companies today for your homeowner, your auto, they have what are called a reserve fund, and they put aside money for future claims. This is how they stay solvent, or help, one of the ways they help stay solvent. All right. The Nfip never had a reserve fund, and they always just went to the Treasury when they had claims higher than the money they were taking in. And so Congress said, hey, build a reserve fund. So you'll see on the declaration pages, the front page of the insurance policy, a thing called the reserve fund assessment, now 18%, that goes into that fund. And those reserves are used first to pay claims before they go to Uncle Sam Treasury to pay for it. Well, in the second act of the Reform Act, the Homeowners Flood Insurance Affordability Act of 2014, some call it HFIA, they actually rolled back some of the rates and things they did in the Biggert Waters bill in 2012. And so they had to have a balanced budget. So they said, okay, we're going to return, since we're returning money this way, we've got to charge money over here. So every policy now receives a $250 surcharge, except for primary residences. Again, remember the primary, non-primary coming in again, they only have to pay $25. And it's all policies. It doesn't matter whether it's pre-firm, post-firm, preferred risk policy, whatever it is, they're going to pay it. The good news is that money goes to that reserve fund to help pay future claims on that. But that those surcharges are around until all subsidized premiums go away. And that's going to be a really long time, like your grandchildren's grandchildren type. Other ones that kind of relate to you that I'll throw out there, that lender implementation type, the mandatory purchase requirement. I talked about that if the house happens to be just slightly out of the floodplain, it's in zone X, and the garage detached, and that's all it's used for, is slightly in the floodplain, zone A, the mandatory purchase requirement is not triggered, and you can get a preferred risk policy. I talked about the escrow earlier. That used to be if you escrow anything, you have to escrow flood insurance. Now you have to escrow flood insurance, no matter what on the loan. Here's the lapse. If a policyholder allows the policy not to be renewed within for more than 90 days, or he or she does it twice within 30 days, then that policy, if it was a pre-firm policy or if it was a newly mapped that we talked about, would be charged full risk rates when they wrote the policy again. Let me say that again. If I have a pre-firm policy in a high risk area, or I have a newly mapped procedure, they've gone from zone X to zone A, and I renew my policy and I renew it, and then the bank, let's say, doesn't renew it, and the insurance agent doesn't catch it, and it lapses for 90 days. And the lender writes finally and says, hey, oops, we need evidence of coverage, or we didn't do it, whatever. Somebody catches it. It will be rewritten as a post-firm building. That's an expensive mistake. You will lose out at the newly mapped procedure and will have to use the new Zone A full risk rates. Moral of the story, don't let the policy lapse. Ensure that you tell your clients, again, you're not the insurance agent, but remind them, hey, once you get in, make sure you continue to pay that renewal. And we encourage the insurance agents to work renewal. Sometimes they don't. They think it's just automatic, everybody pays it, but sometimes the lender forgets to. Now, people say, oh my gosh, the rate's been going up and nuts and crazy. So I just threw this slide in here and let you know, yeah, they had actually gone up, then they went down, they were around 5-6%, then slowly crept up to around 9-10% on average. But you'll see in the post-firm, those are the actuarial rated ones, like Zone A, we're seeing, minimal increases. Look at the increases there, very minimal increases. However, because we're seeing more and more floods occurring in Zone X, the preferred risk policy actually seeing a pretty good jump up in premium, 15% increase. That newly mapped multiplier, that's the every year once you're got a newly mapped rated policy. Right now, it's still going at 15% a year on average. So yeah, some rates are going up high. That pre-firm subsidized, that's mandated by Congress, 25%. But a lot of them are just seeing the 1, 2, 3% increases that are actuarially rated. A couple other things, I mentioned these. Primary residence, you can have two. Let's say it could be a house on the lake and a house up in Minnesota, where the wives, or it could be down in the beach in Galveston, or Corpus Christi or whatever, where the husband loves being in Dallas or Fort Worth, and the wife does too, but really likes to spend half the year up in Minnesota or on the beach in Texas coast. Well, now you got two primary residences, and FEMA's like, well, how can you have that? Well, you do. And so if they can show evidence to the agent that she's living there and he's living there for 6 months or more, and I guess their marriage is working, they have two primary residences. That's important to know, remember, because if it's secondary and pre-firm, you saw that surcharge, that higher premium that goes for secondary pre-firm homes, high-risk areas. I talked about the extra 12 months that you get, newly mapped procedure, that just came out not too long ago. It used to be if you went to a private policy, you could cancel the Nfip for duplicative coverage. And FEMA kind of removed that, and then they brought it back October of 2 years ago. And then they looked at it legally and they said, no, we can't do that. So anytime you want to move to the private policy, you have to do it at renewal or when you purchase the home. But I'll talk to you in a second about something you have to be aware of if you move to a private. 2 to 4 primary buildings could be a primary residence. Again, think about the rating that I talked about, primary residence. How can a 2 to 4? Because one of the 4 is the owner. And they didn't have that before, which makes sense. So we covered a lot in this section. And the one thing I want to get across is about the impact of pre-firm buildings, because that impacts the premium that your client's going to pay on certain types of occupancy. So Elizabeth, if you put up the poll question, check which pre-firm buildings, hint, hint, S, receive a 25% annual rate increase. Is it a primary home? Is it a vacation home? And I threw one in there, a farm. Let's say it's a commercial farm. And there could be more than one answer. I feel, Elizabeth, like maybe we should have the Jeopardy theme playing next time I do this.
I like that. I think that would be fun.
In the honor of Alex Trebek. Okay, we're getting pretty filled up. I like what we're seeing. Over 80% of you said the vacation home. Absolutely. So keep that in mind. Pre-firm, high risk, secondary use is going to be charged a lot more than if it's their primary home. But a primary home is only going to get at most 15 to 18% increase. I think we're seeing an average around 10 right now. A farm used for commercial and stuff is going to be used, rated as, if it's pre-firm, as a commercial structure, it too will be seeing a 25% increase. So 1 out of 4, you got that. That's great. So the answer to this is the vacation home and the farm, because it's a commercial structure. If it was an office building, a donut shop, whatever it might be, a grocery store, and it had an Nfip policy, it would be counted, and it was pre-firm, high risk area, it'd be getting a 25% annual increase until it reached its full risk rates, which again, the insurance agent needs to do with the elevation certificate. Great, thanks everybody. Okay, so next I do want to spend a little time about private flood insurance, because we're seeing more and more of it in the marketplace. And I used to run, as you probably heard, a insurance company that sold the flood insurance policy known as a write your own company. And back then in the late 90s, I wanted to develop and offer an excess flood, which means right now the limits are $250. It would be a policy that covered for those more expensive homes. We went up to a couple million actually, but there was no, back then Google wasn't a great search. And so I had to do the old fashioned way of call and ask. And so I learned a lot, and I put it all together, and I was actually asked to present it at the National Flood Conference in 1998. And then I continued to do that till 2014 when the reform legislation came out. I'll explain what happened there. But at that time, I found there was about just a dozen or 10 to 12 companies offering a competitive product to the Nfip. Not a lot was out there, and they weren't writing in many places. Now it has exploded to over 50. Why? Because when the reform legislation came out and those rates started to go up a lot more quickly, it became more competitive for companies to jump on. In fact, I think we got close to 60. There's 2 different markets. One's called admitted, one's called non-admitted. And I won't get into the details due to time, but basically admitted means an insurance company submits its rates and policy forms to the Department of Insurance in that state to be approved. And any future changes, policy form or rates, have to be approved. That's kind of tough with catastrophe coverage, because as opposed to homeowners where we have so much data from claims, and same with auto and ages and genders and locations and whatever else, we've got so much data. But catastrophes, you have a flood, you have an earthquake, whatever else. So these companies have to be a little more nimble in the rates and policy forms, especially the rates. So they usually then do it through what's called non-admitted, which means they have to be financially solid as a company to be approved to write in that state. But they don't have to submit the policy forms or the insurance rates. A classic example of a non-admitted carrier is Lloyd's. And so they can change those rates each year the way that best fits the marketplace or for them. But really, a couple things have been driven it. One, new technology. There are new ways to tell about, to gather information about a property's flood risk or wildfire risk or whatever it might be, than we had before the reform legislation in 2012 and 14. And we now have guidance telling the lender how to accept a private flood policy, because it has to be lender compliant. If it isn't as broad as the National Flood Insurance Policy, then the lender will not accept it. And so it went through several years of getting that. We finally have some guidance, except for FHA, which I'll mention in a minute, out there. So that's made it easier and made this explosion of carriers. And then as broad as you heard me mention, so it, whatever the NFIP offers in coverages, to be lender compliant, it has to offer those as well. But what we're finding is they're going beyond that. So, and they've also made it easier. Instead of that, remember that long declaration page I showed? Now they're able to do quick quotes with 12 questions, move a little toggle switch, whatever else. Here's a premium on my mother-in-law's house in Miami, Florida. I don't have her flood insurance policy itself, but I knew her address and knew her flood zone. And here's 2 different carriers within minutes. I didn't need an elevation certificate. I didn't need to do a flood zone determination. And I came up with some premiums. Fairly close, but she is on a waterway. She's in a zone A. But very close to the water. So pretty expensive, but you pay for living in paradise, I guess. But some of the property owner considerations to have out there is lapses. Remember I talked about lapses in the previous section? If you have an NFIP policy and you get a really attractive quote on a private at renewal or just before renewal, and it's cheaper, it's offering additional living expense, which the NFIP policy doesn't, let's say. It offers broader basement coverage for those that may have a basement in that area. We have one company that offers what's says, here's $10,000, use it as you want, additional living expense, clean out the swimming pool, whatever it might be. So you're really attracted by that. So you say, hey, I'll go to the private market. 2 years later, a couple floods later, the insurance carrier says, I'm not going to write your policy anymore. And you can't find any other private carriers. So you go back to the NFIP. Well, if you had a newly mapped procedure, you would not get that again, because there's been a lapse in coverage, and there's a rule in FIP says if there's a lapse in coverage, if you remember, or newly mapped, then you have to be rated using the new map. So you could have gone from that low cost $500, $600 policy to suddenly a $12, $15, $18, $2,000 policy or more. Or if you were pre-firm and you let it lapse, you'd go back and be rated post-firm. Well, if you're a -4, which means you're way down here, your lowest floor is way below the base flood, that could be really expensive mistakes. So make sure if somebody talks about private flood, say, talk to your insurance agents, because there's a couple of things you need to consider. And then when you do come back to the NFIP, there's going to be a waiting period of 30 days. Why? Because it's not lender required. So now you're suddenly exposed to the elements in Mother Nature of possibly being flooded and not being covered. And finally, I didn't mention it earlier, but non-admitted carriers don't have access, the policyholders, to the state guarantee fund. So what is the state guarantee fund? Basically, if I'm an admitted carrier, then my policyholders, if I go belly up and I can't pay their claims, the state has a guarantee fund that says we will cover those claims, but only for admitted carriers. So if my policy is, for example, with Lloyd's, and one of my syndicates go belly up and can't pay claims, or I'm one of the other many companies that are out there now writing and they're not admitted, they're SOL. They've got a flooded house and no money. So a couple of things to consider about private flood insurance. So where's FEMA in all this? All this new technology driving towards quick quotes, more representative of the risk for that building instead of just a big broad zone A. Well, they're redesigning their rating system as well. And they're calling it Risk Rating 2.0. And basically they're trying to do the same thing. Let's gather all this information from all the data we already have so the agent doesn't have to go get it, and give it to the agent so they can then provide that quick quote, just like the two examples I gave you earlier in the private market. It makes it easier for the agents. It represents a picture of the risk of that property specifically, not broad zone A. They're including more different types of flood risk, including pluvial, which is just rainfall, which is a lot like what happened with Harvey, and ensures that the rates stay risk-based around that individual property. So they plan to introduce the rates in the whole new program. I mean, this is a whole new program. They've been rating the same way since 1978, table-driven. And so now FEMA said, hey, we know we need to change the way we do. We need to represent that property much more accurately than we have been. So they've created the system. April 1st, so far we're told the rates are coming out and the whole, what the rating program is going to be about. And then October 1st of this year is when it'll actually kick in. So look for those renewal notices for October 1st renewal policies. Look for them to be coming out in July and definitely in August on that. I wish I could give you more information, but if you do want more information, they do have this website I have at the bottom. In a couple of places, you'll see that little globe with the little property marker on it. Those are hot linked as well. In some cases, I've had to embed the links right into the diagram. But anyway, there's a link down at the bottom to help you learn more and stay in tune. I'm going to skip this question part, Diane, and move to the resources so we have more time at the end. The following resources are ones that Diane and I have put together to help you identify the flood risk and then help communicate it. Again, getting into the actual rating, yeah, you and I both know that's for the insurance agents to take care of, but this is to help guide you. Where do I find or send my client to learn more? The first is the MAP Service Center. On the MAP Service Center, and you see the link there at the bottom, not only is it the current, but gives you preliminary flood maps. If, especially for the insurance agents, they can get some of the older maps to say, hey, maybe it could have been grandfathered even way back then on that. I'll talk about the interactive maps and formats that they now have because everything is going digital, though we still have a lot of old maps on there that may have been digitized but aren't to digital as they are today. For example, in Texas, you can, let's say, go into that MAP Service Center that I mentioned. On the left-hand side, search all products. Then this pulls up, you put in Texas and all the other details right below it. And it tells you then, here are the products that we have. A product being the effective product would be the effective map. Preliminary product would be the preliminary flood map, that's why we're here today, because we have preliminary flood maps. What's cool about things being digital now is that you can go in and put in an address and pull up your property. So there's this thing called the National Flood Hazard Layer. It's not the National Flood Football League or the National Hockey League combined together. It's this viewer. And this is what, when you go there, there's a link at the bottom that you see. And you can go in and zoom in and move this black, you see on the little left-hand side next to the white triangle in the red box, little black marker. You can move that pin and put it over your property like I have here. Hopefully you can see on your screen a little orange dot. I put a circle, that yellow circle is my circle, and create a thing called a format, a mini map of that area. And this is a great way for realtors, you guys, to identify what the current flood risk is here. And then if you click then on that, it will create a report, a PDF, that you can then open up and show your client or keep in your files or save on in your computer if you're not doing paper. And it actually then is a picture of the flood map zoomed in of your property. In this case, we've got the BFE showing as well as the flood zone. And the brown is the moderate risk, and where you see no color is the low risk areas. So it's a great way to identify and show your client what the flood risk is. But we have right now new maps out, preliminary maps. So what are the changes? So FEMA has this thing called the Flood Map Changes Viewer, and allows you, it operates the same sort of way. You go in, you zoom in, you put your dot, and again, I put the yellow circle around it. You hit run, and it generates a report. But in this case, if you look on the left-hand side, that's the current flood map, or effective. And it shows in the middle of the rows, flood zone X. And in the new map, it shows it as flood zone AE. So this property, when the maps become effective, if no changes occur between now and then, is now going to be identified to be at higher risk. So if you have a client who's interested in this property, this is a way to alert them saying, I know you really like this property, but know that it's going to be in a high risk area. And if they still really love the property, encourage the current owner or make sure they have a policy, because then that current owner could transfer it over to the new owner. Or if they're buying it, make sure that they get a policy and keep it in force, so when the new maps do become effective, if they buy it before that becomes effective, they get the benefit of the newly mapped procedure. So again, knowing the different rating options, knowing what's happening there on the map, you can help guide your client to a more informed decision about buying it. If you want to keep up to date on all the map changes going on in Region 6 or in Texas, we've got this status of map change webpage. Note that if you have your own website, or you're part of a group that has their own website, FEMA has updated their website. And many of the links are broken, missing, gone, or retargeted somewhere different. So Diane and I have been updating this on a regular basis. And right now, we hope all the links we have here are the most current. It's a different look than maybe some of you might have seen in the past. But here's where you go for those map changes. And there are times, as member Diane mentioned, that you can appeal a map scientifically with technical data when the appeal period happens, or once the maps become effective, your client's house may be it may be, quote, in the zone A, but in the floodplain, but it's up on a little higher hill, or the line is a little refined and it's right close next to the building. You can get what's known as a letter of map amendment, or a letter of map revision based on fill. Fill meaning, maybe somebody put fill in and got it just out of the floodplain. So you can use those methods to remove it from the floodplain. A letter amendment is a letter that literally amends the map, and they actually now do digital technology, actually put that point on the National Flood Hazard layer so people can click on that, and it's there as a permanent record. Want to learn more about it? There's the website for that. If you want to learn more about the whole risk map program, not only do they have this webpage, but they have it as the bottom for real estate professionals and others. And it kind of goes through things that you should know as well. Another one that I really enjoy and promote everybody to use, maybe put a link on your group's website, is the floodsmart.gov. While it's for the consumer to help explain, it also helps you understand it. But what I really like is this section in the agents floodsmart.gov. And again, it says it's for insurance agents, but they've got, which helps them in selling, marketing, and servicing their clients. But here, go to the mapping toolkit. And when you do that, see those three blue rectangular boxes in the middle? Those just explain what I did in the first hour, explaining going from moderate to low, from high to moderate, and then from high to even higher. And it's a great refresher. So besides wanting to hear my voice again and listening to this, as you heard Elizabeth is recording it, bookmark this and go back. Very quick, easy explanation about the map changes and the options, just as I described it. But while you're there, download this and put this on your group's website, or use it to help explain and understand what the impact of flooding can be. Some people say, oh, it's just a few inches, I can handle it. Well, here I put in an example of a 2,500 square foot house. 6 inches of water causes over $50,000 of damage. Where's your client going to get that money? Are they going to have to borrow from their retirement fund? Are they going to have to borrow from their kids' college fund? Or just get a preferred risk policy or whatever policy to help cover that flood damage. And you can, I don't know if you can see my cursor, but you just move this marker up and down to a couple inches or even higher. And it's pretty eye-opening of what just a few inches of water can do damage-wise. So what about you guys? Well, FEMA has created a couple documents. Actually, there were a few more, but as I mentioned, they've kind of gone AWOL off the website. They may be being updated. I know FEMA is also updating a lot of those documents, and that's why they are pulled off, because they do have old links in them, et cetera. One is the Real Estate Professional's Guide discussing flood insurance. Again, excuse me, don't want you to be experts, but it helps you do that. And then questions and answers that you may get from your clients. So it helps you understand the program better. The links of these are new. They're very long. So I've actually embedded them into this. So when you get this PowerPoint, just click on the document itself. Let me finish up here. Check on how we're doing on time. Yeah. Let me finish up here with talking about the disclosure notice that you have in Texas. Now, I'm not a Texas realtor. I don't want to pretend I know your business as like you know it, but I loved the aspect, I don't know if you do, the aspect that they do ask about the flood risk. And so I just took a couple of the questions and put them here. And then in red is kind of what's on the document. And then in blue are just some of my thoughts. So one is, are you, the seller, this is question 6, aware of any of the following conditions? Basically, does it have flood insurance? So some people may say, oh, yeah, I'm covered. Why? Because they assume that the homeowner's insurance has flood insurance, flood policy. Majority of homeowners insurance does not cover damage due to rising water, flood damage. Maybe, you know, the toilet upstairs, the seal breaks and it floods for 3 days. Yes, that happened to me while I was on vacation, but that's covered by homeowners. So the rising water, you need to get that single peril policy, which is through a private carrier or through the Nfip. You can get the preferred risk policy, which the good news is it also includes contents coverage. Do they have a grandfathered rate? Because as you mentioned, that policy rating, it should say rating, not policy rate, can be transferred at closing. Actually, the policy rate there can, but then it will go up in time. Because of the big disasters we've had in Texas, some people didn't have coverage, got individual assistance grant, and with that, they got what's known as a group flood policy. Limited coverage, I think just over $76,000 or so in coverage right now. And that's a 3-year policy, and then it goes away. So when they say they have it, maybe it's one of those. Or do they have that private flood? So just those are a couple things to just keep in mind, ask to better understand. Previous flooding due to failure or breach of a reservoir or controlled emergency release of water from a reservoir. If the person has a flood policy, the buyer can request the seller to get a claim history from that current owner. So only they can't go straight to the Nfip, your client, but the seller can, or the current owner can. And then get the flood map, pull it up. Where's the high risk areas? How close are you to a reservoir, dam, or levee? Because the flood risk may be there, even though it may be marked as a zone X, as we know flooding occurs in those areas. Was there previous water penetration? Again, just because it may not be in a high risk area, zone A, let's say they're in Dallas, doesn't mean it hasn't had some flooding occurred to it. Right, yes, if you're aware, and check wholly or partly applicable. Is it in a 100-year floodplain, that high risk area, special flood? There's the fermet. Pull up a fermet right there, it'll tell you how to get it. And it will tell you the floodway there is that red and blue striped area. And in the floodway, there is very restricted building that can occur, if any, depending on the community. And you can always help attach a fermet to help explain or show that to, if you're the seller, to that individual who wants to buy. Have you filed a claim? Well, double check, is it not just the Nfip, or is it a private policy as well? And again, as I mentioned, the buyers can request the flood history from the seller, the current owner of that. Have they received assistance? Remember, I told you about that individual assistance. You may have to get a group flood policy. So check out to see if they've received any. Did they get maybe a group flood policy or not? If you want to quickly bone up on flood insurance requirements, there's a good document. Easy to read, easy to understand, very clearly puts out some of the requirements. Let me finish up with this. Actually, I've got one slide after this, but as far as disclosing flood insurance and the like, this was turned on to me. I've worked some with Mr. Perez up in at your National Association of Realtors. And he said, hey, Bruce, did you know that we have this? And I did not. And if you haven't seen it, here's a YouTube video put on by NAR about an actual law case that happened in Texas around the importance of disclosing about flooding and flood insurance. Finally, what about the clients, the property owners? 3 ones that I have here, just ones, maybe if again, you have a group office you work out of, might have handy or have online, or you can just email to them if they got a question about flood insurance. Again, always guide them towards their agent and floodsmart.gov about the preferred risk policy. Easy one-pager, helps explain it. Map changes, again, just like I went through the first hour, this covers those map changes in a very easy to understand language, front and back only. And the summary coverage of what does the Nfip policy cover? We've got another easy to read document that just covers summary of coverage. You yourselves might be wanting to know. And again, these change their location on the FEMA.gov, so we have embedded the long links into the documents themselves. So we have come to the end here. We have time for some questions, but before that, I want to ask one more polling question, if I could, Elizabeth. And again, kind of reiterate what we said at the beginning. Do you live in a flood zone? A, not this one. B, still not this. This one's not the answer. C, yes, we all live in a flood zone. D, go back to C. All right. Let's see if we can get everybody to vote in on this and see if we can get close to 100% on that. Well, someone's being cheeky and put in not this one. That's actually probably a true answer. All right. Looks like we got pretty filled up there. Awesome. Thank you, Elizabeth. So yes, we all live in a flood zone. It's the level of risk that is changing. And with these map changes, some people will be newly identified to be at high risk. And in some cases, people will be at a high risk and now at a lower risk. And in some cases, that base flood elevation is going up. But hopefully you've walked away with knowing that there are rating options to help reduce that impact. Newly mapped procedure, grandfathering, and its importance of trying to encourage people to stay financially protected with flood insurance. But also in the second part of this, hopefully you've learned to know the characteristics of the building. Is it built before the first flood map? How's it being used? Is it a primary residence, secondary residence, commercial because that affects its insurance costs, which could affect whether somebody wants to close on the deal or not. And then finally, the resources at the end are there to help you guide your client to look up how is the flood risk changing. It might be great news and is a great selling point, or you might want to inform your client that, hey, it's going to be in a high risk area. Let's look at the insurance costs before we go any further. So hopefully you walked away with some stuff. I've got some really smart people, if the slide pulls up here, with the resources. You've got Alan Johnson, who is the engineer on this project. He was unable to be on the call today. Diane Howe, you heard from the beginning, and she's been answering questions there in the chat. She's the risk map lead, which means she is overseeing all the mapping projects going on. You saw that huge number in Region 6. There are a whole lot. Mr. Flood Insurance is Gil Gilroy. He's the insurance specialist there at FEMA Region 6. He's been on several different sides of the insurance program or the Nfip and really understands it from those different directions. So if you got a question about flood insurance, send it to him. And I don't mind taking questions as well, but he's your representative there in Region 6. So hopefully you'll be getting a copy of this presentation and also this resource guide. Diane and I updated the links as of a couple, last week or the week before. So hopefully they're still good. And with that, I'll stop and see what questions we may have, because I know we have a few minutes left.
There's a couple of them left for you, Bruce. One of them is up at the top here. It says, what if a residential lot and only part of it is in low risk area zone? Can the builder build on the area that isn't in the flood risk zone, and is no flood insurance needed?
So I'm glad that question was brought up. I should have highlighted maybe a little higher. A little more. The requirement for flood insurance is only if the building itself is in a high risk area, the special flood hazard zone A in Dallas area. So even if part of a zone A may be in the property, let's say the northeast corner, and you're wanting to build in the southwest corner, that's in a zone X, then flood insurance is not federally required. Now, the lender could always require it, but is not going to be required. The building requirements check with the community, but often are what flood zone that building is in. So that flood zone, the building would be in a zone X, would be to whatever the zone X building requirements are for that community. So the building, it's when the building is actually in a high risk area do the building, typically the building requirements and the federal mandatory purchase requirements kick in. Hope that answered the question. If not, send a chat to Diane.
Okay, and there's also a question about, can we give information about insurance agents in the area? And I know we used to be able to, but can you speak to that as well?
Yeah, a while back, I worked on as Diane knows, the Nfip marketing campaign called Flood Smart from its start back in 2002. And we developed a listing of agents who were very interested in the being kind of like a referral type agent. Unfortunately, there was issues with the website that had been created at that time. And so all of that was brought down. And by the time it got all brought back up in a new environment, et cetera, all of that kind of went to the side. And so FEMA does not have a referral program at this time, fortunately.
Okay, and then I was just going to make one remark that I forgot to mention earlier. So Dallas and Tarrant are moving forward. So they had their map. We also have, that was just released on February the 5th, Collin County had 4 panels that went out also. So if you have property in Collin County that you're interested in selling in that area. And Ellis isn't that far from us also. Ellis County has some preliminary panels that will be going out on April 13th. And I wrote some information in the chat also about the difference between preliminary panels and then when they go effective. So I hope you read that, but you can find some more information on that timeline. But basically those panels are called preliminary. The next step is when they have the appeal and comment period, but they're not effective until after they've gone through that appeal and comment period. We've made all the adjustments in the map, if any were needed, and then we release the final map And then there's that compliance period where the community has 6 months to update their flood ordinance and adopt the final maps. And so it's after that's done that becomes the effective map, after that 6-month compliance period. So that's when the map becomes effective. And it's usually printed somewhere in the paper, but you may not see it because a lot of people don't get the paper. But it is listed there in the very small print, probably in the back of the paper, if you can find that part. And there was one other little question that came in, and it's a good question, Bruce, if you want to answer this one. But basically, if you've been told by the a builder that he's got a house and he built it it's in a zone A, but he tells you that he's taken it out of the flood zone, what should your response be to that builder?
Well, if he's using fill and he's got it approved by the community to use fill to then bring its lowest floor elevation using fill up, and that's been approved by the community, then the comment would be, that is great, but that property is still going to be surrounded, like behind me, by water. So still encourage whoever ends up buying it to purchase flood insurance. Bringing in fill is one way to help what we call mitigate, reduce the flood risk, which can be a good thing, but it definitely has to be approved by the local community. And still, flood insurance is strongly recommended because, again, he has just reduced the risk. He has not removed the risk. And Mother Nature doesn't follow those flood maps, unfortunately.
Great. Thanks so much for those. And I believe that answers all the questions we had up there.
Great. All right, Elizabeth, I'll turn it back to you. I'm sorry, Diane, did you have something more to add?
There was on Johnson County. We can look that up for you and send some information on that, Elizabeth, that you can share with the group, okay?
Okay. Well, thank you, Bruce and Diane, and thank you everyone for joining us. Have a great afternoon.